This is part 4 of analyzing a deal. In this part, we're going to dig into the key metrics, analyzing the P&L, and then determining a good or bad deal, what makes a good or bad deal. So let's dig in. So what is needed to determine a good or bad deal? So these are some of the things that go into it. The debt and funding, what sort of, debt you're getting on this property if you are getting financing. Is it hard money loan, bridge debt, just traditional financing, that kind of stuff is important in factoring in how the deal is going to turn out. Putting together a multi-year profit and loss is key. So actually breaking down all the income expenses, all those figures, how they're going to, track for the next couple of years, usually 5 to 7 years is what you want to do to get a better outlook of the whole property from beginning to end of your business plan. So you definitely want to put a profit and loss together that's multiple years out. Some of the key metrics that you're going to want to look at: cash flow. We touched on this before, but cash flow is just the income that's left after you pay all the expenses and then the mortgage. So you want to get a property that cash flows, because if times get rough, maybe the value of the property drops. That property is still going to be able to cover its debt service or its mortgage payment, and then still put money in your pocket each month, so you can survive rough times with cash flow. So it's key to get properties that are in areas that cash flow. You also want to look at the yearly return on investment or yearly ROI. So the cash flow can vary on how good it is based on basically how much you're putting into the property. And this is where the yearly ROI comes in: how much you're putting in, and what return on that money that you're getting through that cash flow. So $10,000 in cash flow a month could be worse than $5,000 in cash flow a month, depending on how much money that you have to put in the property with money down, renovations, all that kind of stuff. IRR, or internal rate of return. So this is a metric that analyzes the return of a property. Takes into account time value of money. So it takes into account multiple years, the income coming in, income going out for multiple years, and then a sale on the end of that. So it takes into account all these different factors. It basically discounts the money as the time goes on. So the money now that you're getting out of the property, say year 1, is worth more than year 5. So it's a good factor. The problem that can be with IRR is if you're getting some of your estimations wrong on how much the income is going to go up, how much expenses are going to go up, what the exit cap rate is going to be, all those kind of things. If you get any of those wrong, you're really going to mess up your IRRs, and your IRR is not going to be not going to be helpful if you're messing up a bunch of your projections or what you're estimating. So stabilized yield is another one that's good. This is kind of just a snapshot in time analysis. You're not taking into account cap rate or any other kind of factors like that in the market, interest rates, stuff like that. You're just looking at the property, what you put into it, what it's going to be when it's stabilized, and just what your return is there. So that's a good one that doesn't take into all the factors of IRR, but we'll get into that later. Debt service ratio. This is what the bank looks at. This basically is just a ratio that covers how much you can cover the mortgage. Traditionally, banks will look for 1.25. That means that the NOI that you have for the property should be 1.25 times the mortgage payment for the month. So that means you can basically cover the mortgage payment plus 25%. That's usually what the banks are going to look at. During tougher times, that might go up to 1.3. During good times, that might go down a little bit. But traditionally, 1.25 is what they're looking for. And that's also a good figure to show you that your property is going to make some money if you have a low debt to service ratio. It's getting hard to get funding, but that's also your indication that maybe this property doesn't make sense. So exit strategy: are you going to sell the property once you get it stabilized through value add? Are you going to do a cash out refinance? Does it make sense to do a cash out refinance where you can pull a lot of the money back because you added a lot of value, but it's still going to cash flow even after you take on that higher debt for refinancing? So that might make sense. It also depends if you're doing a bigger deal, what your investors want. Do they want their money back now in a sale, or do they want some of the money back through a refinance and then continued payments going on there? So it all depends on the property and what makes most sense, and that also can change as the years go on. 3 years down the road, that outlook might change. So you always want to assess that kind of thing periodically. So funding the deal, are you going to get bank financing? I already touched on this. Your normal loan. Hard money is more short term, high interest rate that works for, if you're doing a quick turnaround on the property, doing quick renovations, kind of get maybe 12, 18, sometimes even 24-month, but it's usually shorter term and higher interest rates and high fees. Did you get seller financing on the property? This is when the seller actually finances, basically becomes the bank for you. You agree to terms with them that work for both the parties, and then they basically act as the bank, and you pay them based on the terms that you agree to. What are the terms? Some of the key stuff is obviously interest rate. What do you pay in interest rate? How much money do you want down? What's the loan to value? Basically, if you have a 75% loan to value, that means you're putting 25% down. How long is the loan out? The longer, the lower the payment's going to be. Do you have any interest only? Did you get a loan that's interest only? Some loans will be interest only. Some banks will work with that they'll be interest only for the first couple years, maybe 2-3 years. This allows you to get a lower payment this first couple years, maybe when you're renovating the property, but you're not paying down any principal because it's just interest only. But it's a way to get the payment down at first while you're stabilizing a property that might be, high vacancy rate, lower income. So once you get that, there's renovations done and everything like that, then, then the principal kicks in and down the road. So what money down? So when you're looking at money down, you're going to look at things like the down payment, which, like I said, is if it's 75% loan to value, you're putting 25% of the purchase price down. Closing costs, a good factor for like smaller, middle-sized multifamily, you can use 5% of the purchase price to usually be closing costs. And then renovation budget. So what sort of renovations are you doing? And that'll give you a whole number of what that you're putting into this property. So like over here on the right, you can see you got down payment, $115,000, estimated closing costs almost $37,000, and then you're putting another 75, 35, and 25,000 into the property through unit renovations, exterior renovations, then other miscellaneous items. So you're going to bring $287,000 to the table in some way. So a multi-year profit and loss. This is kind of what I lay out and how I look at it. You're going to need to know the stabilization period, and what I mean by that is how long it's going to take you to renovate all the units to get them to where they're all up and the property's running good. You have got those after reno rents for all the units. So how long is that going to take? Traditionally, there's going to be you're going to want to budget a higher vacancy rate while you're doing that because there's going to be lots of turnover. If you're renovating units, kicking people out, or they're just moving because they know they had gotten away with low rent for years and now the rent's going to be going up since you're renovating the property. So I always budget during that stabilization period slightly higher vacancy rate than what would be normal for that market. What sort of annual increases are you going to build in as far as income, expenses? You definitely want to build in expense increases. Find what's typical for your market and use that. For the rental increases, once it's stabilized, then you want to put some sort of rental increase in, depending on what the market's at. If it's something where it might be stable for a while, then there's going to be no increase, then you can put in 0. But just be conservative with this. If the rents are going to keep going up, don't budget something crazy because it's going to make the numbers look really good. And then if you don't hit those numbers in your analysis, is going to not reflect that, and you're going to have bad returns. I would say project out at least 5 years. You can go out to 7 like I did here, or if you're even going to hold it for even longer, you want to budget out that way. But 5 gives you a good snapshot in case you're going to sell at 3, sell at 5, even hold it longer than that. But 5 is a good kind of number for that. And like I said, you break down the annual increases, annual expense increase, and then you do income, expenses. That gives you net operating income, and then cash flow. So you take off the mortgage, gives you cash flow, and then you take that cash on cash or total ROI or yearly ROI figure off of. You take the cash flow that's down there off of what you put into the property overall, and then at the bottom, I build in what equity I'm accruing, and that's equity that's you're paying down in principal so that the loan's getting lower. So you want to factor that in, because when you go to sell it in 5 years, that'll be the difference when you pay off that old loan, or yeah, you pay off that old loan, and then your difference will be what you sold it for minus the old loan and some closing costs. So you want to factor in what you paid down in that loan, because in 5 years, that loan amount's not going to be the same as what it was when you bought the property, obviously. So you want to calculate important figures, like I said, the ones you want to: net operating income, mortgage payment. You want to have that mortgage payment in there, cash flow, return on investment, equity accrued, and then the other thing you want to check is your debt service credit ratio to make sure it's above 1.25. The higher, like I said, the better. And you'll just do that by taking the NOI divided by the mortgage payment, and that'll give you some factor of that. So you want it to be at least 25% over the mortgage payment. The higher, like I said, the better. That means you're going to have more cash flow and be able to, survive harsher periods in the economy. So exit options. Are there any set financial deadlines? Like if you get a loan, does the loan need refinanced, or do you need to sell it 5 years? There's that 3 years or interest only for 3 years. These are the kind of things that you need to know so you can prepare your business plan for the property accordingly. You need to estimate the exit cap rate. What's typically good to do here is the property is going to stay basically the same kind of class. You're just updating it. You're not going from a C class to B class. A good way to do the exit cap rate is go 0.5 higher, at least than what you bought the property for. So if the market cap rate's 7, it's good to estimate 7.5 just in case there's any changes in the market. If you're wrong and it's actually 7 or 6.5, which is better, then that's good for you. But it's better to be conservative and not move this around, and just to make the analysis look good. Refinance. Did you add enough value if you're going to refinance to pull a lot of cash out? How much value was added? Does it allow you to take the cash out that you need? And then when you refinance, you're going to be taking on higher debt, so the mortgage payment's going to be higher. Did you add enough value that when you refinance, pull the money out, is it still going to cash flow? Because that's key. You don't want to squeeze yourself there, because in that case, it might just make sense to not refinance or sell the property instead. Where we get to sale the property, you want to project out the market. Where's that market going to be in 3 to 5 years time, and just always assess where that's going to be. Is the cap rate changing? Is demand for those properties changing? What are they selling per unit? You want to know that kind of stuff. So you want to get recent sales data and always track that. Is the cash flow not going to be there? Is there something happening in the market where people are moving out, the incomes are lower, something like that? And you also want to take into effect or into account your investor and partner needs. When do they expect to get out of this property? What are they looking for as far as returns? What do they need? So maybe here's an example here, kind of related to like the 5-unit property that I purchased. The original loan's $112,500. Post renovation NOI is $16,000. Yearly mortgage payment $6,444, giving you an annual cash flow of $9,556. And sorry, this example is actually for a 4-unit. So that's giving you almost $200 per unit in annual cash flow. But if you refinance it, you get a higher loan for $191. You're going to pull a lot of money out, but now the mortgage payment is going to be almost $11,000. So you're still going to be cash flowing $5,000 a year and slightly over $100 in cash flow per unit. So that's still pretty good. That's what you kind of want to look at when you're going for a cash out refinance. So analyzing the key metrics, NOI up top here, you got this is the outlook that I have for a property that I analyzed. I got the NOI listed up there, and you can see how by the year 3 is when we stabilize the property. So it's currently at 39,000. We think by year 1 we could get to 50, year 2 65, and then year 3 when it stabilizes up to almost 76,000. And then there's just the annual increase. So there's the cash flow, and then the ROI numbers. They don't look good at first, but what you're looking for is a property that can increase as time goes and get into the double digits. And then when you're looking at down at the other figures, IRR if sold on that second line, If you're in the 20s, you're doing really, really good. The projected cash out, that is a figure for the money that you'd be able to take out of the property if you refinance it. So how does that compare to the money that you put into it? As you can see here for this property example, you're returning 115% of the capital that you put into the property at year 3 if you refinance, and you're still getting 30,000 in cash flow after. When you calculate IRR, I have an example down. It's best to just do it in Excel, but basically how you lay it out is you lay out your initial investment as negative year 0. Each year you have the cash flows, and then if you would sell year 5, you'd have the cash flow of year 5 plus the sales proceeds. So that would be what you sell it for minus closing costs minus the loan you have, and that'll calculate your IRR figure for you. There's no sense in doing that manually. And then when you're looking at stabilized yield, purchase price 1.5 million, renovation 500,000, total cost 2 million, market cap rate is 7. At the current figures, the NOI comes out to 104,880, giving you a purchase cap rate of 6.99%, which is right by the market cap rate. So you take that NOI, but you just divide that NOI by the purchase price there of 1.5 million. But when you're doing the stabilized yields, you'll get to, this is the gross potential. This is what you can get to in rent. So your new NOI comes out to 180, 120, but you divide that number by the actual 2 million, which is the renovations and the purchase price, giving you a stabilized yield of 9.01, which is a spread of 2.01%, which is something good. You want usually 1.5 to 2% spread there. So good or bad deal, what I determine good or bad deal, you got to determine your risk level. How's the market? Is it going in the right direction? Is this a property with a lot of work, a lot of renovations that you're going to take into that will be a higher risk? So you got to manage the risk there and what kind of debt you're taking on the property. You always want to do that. What makes sense for the market? Make sure you're renovating to the units and making it something that the market demands and needs. So for my criteria, usually look, if I'm doing a cash out refi, I want at least 90% of my cash out at refinance. And then I still want a cash flow of around $100 a unit after that. For IRR, I'm looking at least 15% IRR at year 3 or year 5 to make it a good deal. Yearly ROI averages start out in the single digits, but I want an average to end up around 10 to 12%. So maybe if it starts out at 4 to 6, it ends at 14, 16% in year 3, 4, 5 to get you up into that double digits. Stabilized yield, like I said, 150 to 200 basis points or 1.5% to 2% difference in stabilized yield versus the purchase cap rate. And like I said, that's a snapshot in time to just give you what you're getting return on your capital, whereas the IRR is you're really planning out what the exit cap rate is going to be, what the interest rate is going to be, all that kind of stuff. You're really taking in a lot of factors into it, where the stabilized yield is just a snapshot of where it's going to where it can get to. And then just an area that'll appreciate over time is always something that you need. Because it'll smooth over a lot of bad problems that you have with the property if the area is just going to get better over time. So if it's a great deal, take the lead, put an offer in. If not, move on to the next one. And that's it for part 4 of analyzing a deal.